I'll be showing you some of the ratios that are very important when you are analyzing a stock. I like you can just put it in Google and you can just search here whatever stock you want to search and just click enter. And I just wanted to show you some things. For example, if I choose stock Apple, I'll just type here, okay, and I'll just click this one. And there are different ratios that's already calculated for you guys, so it's not like if somebody's new, they don't have no clue about it, you can still understand this very well. So for example, the price book ratio, if so some stocks, some ratios that I look at is the book value, um, the price ratio, the debit to ratio, return on equity, current ratio, dividend, and if it's a million company or a billion company, so the capitalization of it, and the FCF. I'll just explain this in detail one by one. So if the book value is bigger than the price ratio, then the stock is attractive. So if you see here, here the price ratios, if you click on the price ratios and go to the price book ratio, you can see that ratio says that Apple is approximately 8.64. If you look at this ratio, it's 8.64 more costly than it should be. So it tells like if the stock is over valued or undervalued, or if it's more expensive than it should be. So to know that you're buying it, maybe you're buying it for a double price. So to know that, you can just look at the price to book ratio. And if you look at price to book ratio in 2011, 31 December 2011, the price to book ratio was 3.69, which means that the real price, it is 3.69 times more than the real price. The stock is more than the real price. And this one, I think this one is the lowest it goes, which is 2.92 times more than the real price. So the lower the number of price to book ratio, the better, usually. So here in 2018, it was 9.94 times more than the actual price, which is not very good. Then it came down to 6.3, which means that it's 6.3 times more than the real price, and now it's 8.64. So if you look at Microsoft, for example, you can see all the stocks you want. And for Microsoft, it says that it was like nearly 3.89 in 2009. Then it was same, constantly same, and now it's 10.92 times more than it actually should be. So which is not very good. So it means that the price of the stock is more than 10 times more or 11 times more than what it should be. So it means it's very expensive to buy right now. But in for example 2012, it was not very expensive, because it was like twice or thrice the price of the actual price. So you need to be very careful, that you need to make sure that the price to book ratio is lower value, so that you're not paying too much. Even though the stock might be good, the company might be good, but you're not buying it twice or thrice the same price, or 9 times or 10 times the same price. So that means that you're buying it very expensive. You can just wait for a recession or for it to come down. You will be able to buy more stocks for that company. Secondly, debt to ratio, which is very important. So if I go to other ratios and I go to debt equity ratio, and if I look at this one, um, debt to equity ratio means that the lower the debt to equity ratio, the better. So it means that if you have a look at 2009, the debt to equity ratio is 0. So it means that they don't have their debt free. The company doesn't have a debt, which is very good for the firm. So they are operating without debt. But if you like go to 2012, then you can see 0.17 is the debt to equity ratio, which means that they have taken debt, but it's still not, it's like 17% compared to the total amount, so it's not a lot. So if the debt to ratio is more than zero point 0.5, if it's more than zero point 0.5, so up till here, up till 2015, it's 0.36, which is not very scary. But if it's more than, if like for example in 2015, it's 0.53. If it's more than zero point 0.5, then it is very risky to buy stock in that firm, because they are operating a lot on long-term debt, on debt. So any company that is operating on debt is not a good sign. So it means they're not able to generate their own money, so they might fail or something like that. So if you look, then after 2015, it has the debt to equity ratio was 1.09 in 2017, and then it came down back to 0.77 in 2019. But still, it's lower than 1, but still it's risky. But if it's zero point 0.5 or lower than zero point 0.5, then it's okay to buy a stock there. It's not very risky. So I've checked this debt to equity ratio in Microsoft. Now, if I want to check, so debt to equity ratio is very important ratio, because it tells you that how the financial condition of the firm, you know. Then there is return on equity. If I go to other ratios, I click return of equity. If I go down, and I can see the ratios here, and if I have a look, in 2005 is 27.78%. So any return on equity means that the return you're getting when you're investing, the shareholder is putting money in the firm, and what return they are getting. So the income, or the return for that money, what they are getting. So if I have a look, the more the return to equity ratio, the higher the ratio, the better. So better returns you're getting. So, but it shouldn't be lower than 8%. If the return to equity ratio is lower than 8%, then it's not, then you can just wait. It's not saying that the firm is bad, but you can wait for it to go up and then start investing in that firm, because it might be too early to invest, and it might not work out. So at least it should be 8%. And then if it's more than 8%, then it's better to buy. So if I have a look here in 2015, it's 13.85%, which is still very good, but compared to 2008, it's still lower, but it's more than 8%. So at least you should have the minimum, which is 8%. So according to this return to equity, if I look at this ratio only, then Microsoft is very good, because it has always maintained its ratio above 8%, but it has got it down and up, but still it's better. Okay, the next one is current ratio. Um, if I click here, current ratio in other ratios, and I can just see current ratio is very important, because it tells you that the total number of liabilities and assets you have. So if the assets are more than liabilities, it's better. So the higher the number, the better it is, in terms of financial condition. So it means the higher the number, the more the assets than the liabilities. So, and it should be at least, ideally, it should be 1.5, should be the ratio for it to be good, or more than that, not below 1.5. So if I look at Microsoft in 2005, it was 2.9, which is very good. Then if I look at 2007, it's 1.5. It's more than 1.5, so it's not very risky, and it has maintained. If I just look, it has maintained throughout more than 1.5. So I wouldn't say that it's a risky. I think the current ratio is really good for Microsoft, and currently it's 2.97, which is way above 1.5. So which tells a lot about the condition of the firm. And some firms pay dividends, so which also says a lot about the firm. because they have extra money so that they are able to pay dividends, because not all the firms are able to pay dividends. So it means that the financial condition could be better than other firms. So it is one of the factor that you need to consider as well. So Microsoft, it pays dividends. So I'll just click all. Okay, so it started with 12.92%, which was a lot of dividend in 2005, and then it just reduced its dividend to 1.16% in 2005, and it has just continued, being up and down, and 2.34, and then 1.42, 1.33%. So dividends tells that they have extra money, so they are able to pay. So it means that the financial condition could be good, because if the financial condition was not good, they wouldn't be able to pay the dividends. They would just cut the dividends immediately, so that they can pay out their loans and stuff. So this tells that they are able to pay the dividends, which means that they have good financial condition. This is also one of the factor. And if I look at other things, such as